Dan does mortgages. Welcome to the next generation.
Thank you for having me on. Very excited to chat.
It's 2025. The average age of a first-time buyer is 33. House prices across the UK are approximately 7 times the average annual salary, and we're going through a cost of living crisis right now. Should people be looking to rent a home as cheap as possible, or should they be looking to lock down a house that they own?
Well, that depends on the individual circumstances and what the goals are. So everybody's always going to be different. But the big question is always, is it a good time to buy a home? What I always say is, if you want to buy a home and it's the right time in your life, so maybe you are sick of renting, maybe you want to move out of the parents' house, and if you can achieve your goal in the current market, so if you can buy the sort of home that you want to buy on an affordable basis, then it's a good time to buy. Reason being, we simply don't know where the market or the economy are going to move in future.
Could you give any specific circumstances where maybe you would actually go, I think it's best that you rent for the next few years and you gear up to getting a mortgage, getting a house later on?
Absolutely. So, as a mortgage advisor, I always say we are not here to sort of sell the mortgage dream. There's perks to renting, absolutely. And, if somebody is in a position where they are struggling to buy, and maybe it's due to a lack of deposit or maybe some bad credit history, and that's causing them to then have to pay higher interest rates and the monthly payment is becoming maybe challenging or slightly unaffordable. If that's the case, then renting can be a fantastic option as you gear up to a future home purchase. As well as that, if somebody is, maybe an extreme example, if somebody is in 12 months' time looking to move to Thailand with a one-way flight and not knowing when they're coming back, then buying a home in the short term probably isn't the best idea. Reason being, you're going to have to pay some potentially quite hefty upfront costs, whether that be solicitor fees, advice fees, stamp duty perhaps. And if you were to then choose to move away and want to sell that property in 12 months, then perhaps renting for the meantime could be a better option.
And I really was desperate to get you on the show because this is a subject that I know nothing about. And researching this has been super interesting, mostly just because of the realization of how important this topic is and how little we're taught about it in school or by parents or parents' friends. It baffles me. So let's strip this right back to the basics. If you're looking to buy a house, you're at that point. What is a mortgage?
So a mortgage is a loan to be used for the purpose of buying a property, and the loan will be secured against that property.
Okay. Dig deeper for me.
Yeah, so when you are buying a home, most people, unfortunately, we are not going to be able to afford to buy the property in cash outright. Therefore, hopefully you do have some form of deposit. You will need a loan on top of that to fund the rest of the purchase. So with that, you will approach banks, building societies, and they will hopefully grant you a mortgage to allow you to complete that purchase. Now, what that mortgage looks like is different for absolutely everybody, in terms of interest rate, the fees attached, the fixed term period you choose perhaps, the mortgage terms, the amount of time that you take to repay that mortgage. It's going to look different for everybody.
Do you know the history of mortgages? I was researching this beforehand and I thought it was a nice little nerdy thing to throw in there. So the Romans came over to the UK. They were some of the first people to adapt this idea of mortgages and securing a property against your pledge. Your pledge is with the property. They come over in 43 AD and they impose this idea of a living pledge. It's called a vivium vedium. And the idea initially was actually that people who were in debt, they got landlords over and the landlords rented the land off of them, and the landlords would work on their land and earn money with the preconceived idea that, say the person was in £100 debt, the landlord would earn £120 whilst they're renting this land and they'd keep that extra £20. So it was quite a cool, productive win-win scenario because these people were in debt and they had some productive land, hence it's actually translated to living pledge. They used that and they got their debts paid off and the landlords took some profit and people benefited from the harvest and whatever else, the yields. And then comes the mortem, and that's the death pledge. It's the mortem vadium, and that is the mortgage system that we still have today, where actually people securing they're pledging land as collateral, and that can be taken away from them. So I thought that was super interesting that we used to have this sort of win-win system, but now it seems it's a little bit more unfairly weighted.
Yeah. So it can be, especially in the current climate. Going back to the Roman times, I'm not quite sure what the interest rates might have been there if there were any. However, at the moment, it is certainly a difficult time at the moment. But yeah, so we can maybe dive into that and what the market looks like at the moment.
Yeah. Well, before we do that, we've got this understanding of what a mortgage is. How do you get to a point where you are mortgage ready if you know that you're thinking about a mortgage, you really want to get a house and lock that down? What are the key things you need to have in mind?
Absolutely. So the overarching point will always be preparation. It's never too early to begin working towards that home purchase, whether that is having an early conversation with a mortgage advisor to understand your current position, so your level of income, debts, having children, any bad credit history, what you can achieve with your current position. Or if your current position isn't going to allow you to achieve your goal, what sort of changes you need to make. So that could be an increase in income, a decrease in debt, an improvement in credit history, and then you can work towards that over months or years perhaps. Okay, so preparation and an early conversation with a mortgage advisor is always, it's imperative. In addition to that, you will need some form of house deposit. Okay. Now, saving a house deposit in the current climate is difficult. Most mortgage lenders will want a 5% deposit as a minimum. That's most lenders. Okay. So that will be 5% of the property value. All right. Now, house prices are so high, even saving that deposit amount can be quite difficult. Therefore, it's important to utilize the tools that are available to us. So a big one, talking about first-time buyers, a big one is the lifetime ISA. So the lifetime ISA allows you to contribute £4,000 annually, and then the government will give you a 25% bonus on top of that. Okay, so that's essentially free money to fund your house deposit. It's an amazing opportunity. Okay, however, there are some considerations we need to make with a lifetime ISA. You can only benefit from a lifetime ISA at least 12 months after you've made your first payment into the lifetime ISA. So if you're hoping to buy and have the keys to a property in the next 12 months and you don't have a lifetime ISA yet, it's maybe not for you. But something we talk about is if you are hoping to buy a home at some point in the future, open your lifetime ISA, stick £1 in, start the clock ticking, and it will be there to use when you are ready. Okay.
How early do you think you should start thinking about being mortgage ready?
You should always, it's more about an overall awareness of debt and credit and finance. Ideally, we should all sort of have one eye on our finances, with the ultimate goal for most people being to buy a home. We should always have one eye on it from the day we turn 18, really. If we want to talk about credit history is a huge one. Should I dive into that?
Go for it.
Perfect. So credit history and debt is a major issue. We should always have an awareness of our credit and our debt habits from the day we turn 18, really. When you do turn 18, letters will start coming through the door from the bank offering you credit cards, whether it's, there's opportunities for payday loans out there. And we can really start to develop bad financial habits from being around about 18. Okay. These bad financial habits or mistakes that we make can then have a knock-on effect on our ability to buy a home in the future. When it comes to adverse credit, so that being missed payments, defaults, CCJs, anything worse, okay, I say around about 50% of my home buyers have some form of adverse credit. That could be something quite significant, or it could be as small as a missed payment on a utility bill, okay? But around about 50% have some form of adverse credit. Of those with adverse credit, over 50% of those don't really have an understanding of what their adverse credit looks like. So the date it occurred, the regularity, the figures involved. And what I find is that adverse credit occurs on most occasions simply due to a lack of awareness or a lack of care. So maybe being young and thinking, How important is it that I do pay my credit card on time? How important is it that I do pay my phone bill on time? And yeah, these mistakes can lead to financial distress in the future when it comes to buying a home. Now, some people may listen to this and think, well, I have adverse credit due to a divorce or a job loss or an abusive financial relationship. So I'm not talking about those people. But yeah, on most occasions, people who have adverse credit, it's a result of a lack of awareness or a lack of care, quite often when they're a little bit younger.
How far back does that history, that backlog go? And how sensitive is it to certain events that might have been a mess up on the phone provider's end, that they didn't take your payment because their payment systems weren't working properly? How sensitive is all of that?
So if there ever is a mistake which is caused by the credit provider, okay, that will still show on your credit report as perhaps an arrear or a default, whatever it may be. If anybody ever does see that and it is an error, you can contact the provider and they should hopefully resolve that and then remove it. If it is then removed, it won't have any knock-on impact. That's why it's important to keep on top of your credit report. Maybe review that at least once a year just to make sure there are no errors. Okay. However, your credit report will display information from the latest 6 years. Okay. So if you've got any form of adverse credit from 6 years ago, that could potentially show on your report. And then that could be factored into credit scoring when it comes to applying for a mortgage.
Okay, that's good to know. That means I definitely can't go for a mortgage until I'm 25 because I've messed up a lot of bills just from being lazy and procrastinating, even when I have the money. So I guess what I want to ask for someone like me who can be reckless, even though they can pay bills or whatever, it's just a case of procrastination. How do you avoid getting into debts and missing things? Are there any systems you'd implement? Are there any low-hanging fruits that we can pick here?
Yeah, so quite a big statement. However, I always say my best credit scoring tip is not to make a mess of it in the first place. Okay. So if from being 18, we can perhaps avoid what you've done in terms of making these mistakes, missing some payments. And to be clear, you are absolutely not the first and you won't be the last. It happens very regularly. Okay. But to start off with, the best credit scoring tip is to avoid that in the first place. Okay. Don't take out any debt that we can't afford or that we are not going to repay on time. Now, if you have made some mistakes in the past, okay, do not worry. It's not necessarily the end of the world. I place mortgages successfully for people with adverse credit all of the time. Okay. But I would always recommend, if you are working towards a goal, such as buying a home, to seek expert advice. There's so much information online regarding building credit scores, achieving a 999 credit score, whatever it may be. And a lot of it is blanket advice and not entirely accurate, in my opinion. Okay. These credit report providers will often encourage you to take on debt in order to improve your credit score. Okay. And absolutely, taking on debt and making your payments on time can often improve your credit score. Okay. However, if you are somebody who maybe struggles with managing debt, maybe has had credit cards in the past and hasn't managed to repay them on time, it's maybe not suitable for you to get another credit card in the immediate future with the aim of then improving your credit score using that card. Why? Because we've already seen you've maybe got some bad habits with that. Okay, so most of us will have some form of regular payments anyway. Okay, whether that be a car on finance, which is maybe unavoidable for some people, whether that be the phone bill providers, utilities. As a starting point, just make your regular payments that you have on time and make sure we're not missing any payments. Okay, in terms of debts that we are taking on, we need to be careful to make sure that our debt to income ratio is not too high. Okay, and also our credit utilisation. So credit utilisation is a huge thing that can impact credit scoring. What that is your level of debt expressed as a percentage against the available debt. As an example, a credit card with a £4,000 limit. If you have a £2,000 balance on that, your credit utilisation will be 50%. Okay. Ideally, we want to keep that at 50% or below. Okay. Once we start getting above that, some mortgage lenders don't like that because it suggests that you are reliant on the debt available to you.
Right. Right. And I really want to get into interest rates and do a deep dive because I think this lies at the core of a lot of the confusion with mortgages and what makes them so scary. So you're buying this house to spell it out for people like myself that have no idea, and you can't afford buying it cash in hand, so you buy it for just a percentage of the house. Before we proceed, actually, what is the most regular percentage to actually put down in cash? Is it 5%? Is it 10%? Is it 20? What's the most common?
I believe the average is around about 15%. However,
Okay.
that is an average and that's not a minimum. There are lots of people who buy homes with as small as a 5% deposit. Okay. There are even mortgage lenders who offer 0% deposit mortgage products. Okay.
Wow.
However, whether or not they are advisable is a different topic altogether. But I would say a minimum of 5% is advisable. Okay. I've seen information online suggesting that the average deposit size is 15%. But yeah, a minimum of 5% is what most people will need.
And you're paying these interest rates on top of the eventual cash sum you're going to get to own the house. Does the trade-off of getting a cheaper, say 10% loan come with higher interest rates?
So when you have a 5% deposit, you will have access to a certain amount of mortgage products and interest rates. When your deposit hits 10%, generally those products and interest rates will improve. That will happen at 15%, 20%, 25%, and so on. Okay, so placing a larger deposit can give you access to a better interest rate, also a lower loan amount, and therefore a cheaper monthly mortgage payment. Okay, but when it comes to buying a home, let's say you do have 15% available. Okay, you may choose to weigh up, do I want to place all of that 15% and therefore have the cheaper mortgage payment, or would I like to maybe place 5% and keep the rest of the money in the bank for spending in other areas, whether it's furniture for the property or whether it's just an emergency fund or to spend elsewhere.
And what's the difference between fixed rate mortgages and variable rates?
Yeah, so a fixed rate mortgage, of which is most common in first-time buyers by quite a long way. A fixed rate mortgage means that your chosen interest rate and the associated monthly mortgage payment is fixed for an agreed period of time. So most commonly, this would be somewhere between a 2 and a 5-year fix. Some lenders do offer as high as 10-year fixes. Okay, the benefit of a fixed rate mortgage is that it will give you a budget certainty. So you know for the next 2, 3, 5 years, regardless of what happens elsewhere in the economy, your monthly mortgage payment is fixed. Therefore giving you peace of mind and meaning you're not sat at home watching Sky News, looking over your shoulder, wondering what's going to happen to your mortgage. Okay? So you know for the next five years perhaps, your monthly mortgage payment will be fixed. This is what most people tend to prefer, and it is what is most suitable for most first-time buyers. Okay? Now, a variable rate mortgage is exactly as it sounds. It means that your monthly mortgage payment is variable. There's a few different types of variable rate mortgage. So the standard variable rate is essentially a rate that the mortgage lender sets themselves. That's quite high and it can be changed at the lender's discretion. On most occasions, we don't want to be on a standard variable rate. There are tracker mortgage rates, which is a mortgage product where your interest rate tracks the Bank of England base rate. So as an example, the product may be your interest rate is 0.25% above the base rate, and your interest rate will then move throughout the years to track the base rate, and your monthly mortgage payment will change. Okay. Now, the negative of a tracker mortgage rate is that it is variable. So you don't know in 6 months' time what your monthly mortgage payment will be. One of the benefits will be is that a lot of tracker mortgage products don't have early repayment charges, and that means you can leave the deal early. So if somebody is, as an example, I've placed a few of my clients onto tracker rates recently because they are actively looking to move home. So their fixed term rate has come to an end, but they are actively looking to move home, but they haven't sold the house yet. So we've moved them onto a tracker rate, which might be slightly more expensive than a fix in terms of the monthly payment, but it means when they sell their home, they can leave the deal early without paying any early repayment charges. Whereas with a fixed rate, that will include early repayment charges if you do leave the deal early.
And from what I've seen online, most fixed rates are only 2 years, and a lot of people that I've spoken to, they started off with a fixed rate for 2 years and then they've gone on to a variable rate. And something that's super scary is that actually, if you start off, post-COVID 2021, where I think interest rates was 0.1% or something crazy, and then they eventually rise 2 years later to 4% or 6%, you're going to be screwed because you've budgeted to be able to pay back 0.1% perhaps if you haven't planned ahead far enough, and maybe you haven't had a mortgage advisor help you out. Suddenly you're paying through the nose hundreds, if not thousands of pounds more per month. You're screwed.
So yeah, it has been a difficult few years for a lot of people. So in, COVID times, as an example, interest rates of, fixed interest rates of 1 point something percent or 2 point something percent were extremely common. And that's what a lot of people were accessing. In the current climate, in 2025, most people are going to be above 4% when it comes to fixed term interest rates. So that means if you bought a home during COVID, let's say you bought a home in 2020 and you took a 5-year fix, when you are coming to remortgage now, your monthly mortgage payment will be increasing. So yeah, it's a challenging time. It's absolutely not ideal and it's not what anybody wants. However, when you are applying for your initial mortgage, a mortgage advisor like myself will essentially run a stress test to protect you against any increases in interest rates and monthly payments, just to make sure that if that does happen, then yeah, you are still going to be able to afford it. Now, something that we see on the news, which is a little bit of scaremongering, is that when, if somebody is on an interest rate from COVID times, let's say they are on 2%, okay? When you come to the end of that fix, let's say that's this year, if you don't do anything at the end of a fix, if you don't remortgage and if you don't choose a new deal, your lender will automatically move you on to their standard variable rate, which is extremely high. That's around about 7-8% with most lenders, okay? However, reality is we should not be moving on to the lender's standard variable rate where it's avoidable. Okay, so you should be looking to remortgage or complete a rate switch with your current lender to make sure you're moving on to whatever the cheapest option is at this time for you.
Who actually decides the interest rates in this country?
So in terms of fixed interest rates, fixed interest rates are not directly impacted by the Bank of England base rate. That's a little bit of a myth. So a lot of the time people will watch the news, see that the Bank of England base rate has came down in recent months, and then expect fixed interest rates to reflect that. That isn't the case, okay? Your tracker mortgage rates will be impacted by the Bank of England base rate. Your fixed rates are essentially impacted by the lender. They choose their fixed rates, okay? They want to be competitive, but they also want to make money, okay? They are essentially impacted more so by swap rates. Swap rates are essentially the rates in which the lenders lend each other money, okay, and how money is moving around the country, okay? But yeah, fixed rates, it is primarily impacted and chosen by the mortgage lenders with the aim of being competitive and also making a profit.
Something I'd never heard of, again, was negative equity. And that's another big scary can of worms to open up for us. So I wonder if you could just talk me through what negative equity is, how common that is, if it's something that people should be actively thinking about, or is that a bit more stress than you should actually take on because it's super rare?
You should always be aware of the potential for negative equity. So what negative equity is let's say you buy a property with a 5% deposit and then that property goes down in value by 6%. Okay, you will then have no equity in the property and fall into negative equity. That can then leave you with difficulties if it comes to remortgaging or having the funds that you need to move home in the future. Okay, now historically, reality is most properties do increase in value over the longer period. Okay, so negative equity, it's not going to happen to most people. However, that doesn't mean that we shouldn't be concerned about it and aware of it. Okay, so particularly flats. Okay, so flats can sometimes have a higher chance of decreasing in value. Okay, as well as that, new build properties can sometimes have a higher chance of decreasing in value. So yeah, with those properties in particular, we do need to be aware of this. But when you are buying a home, I would like to think that you should have an awareness of the area, of the property that you are looking to buy, and you should be able to make an educated and informed decision of the chance of negative equity. But yeah, flats and new builds, and especially new build flats, they do potentially run a higher risk of negative equity.
Right, because you've got these new builds, and because they're new builds, there's not much more you can do to them to increase the value. Whereas if you almost leave a bit of headroom with the property that you're buying, and, I don't think in all honesty, I would buy a property with this as the main focus, but it's worth being wary of. If you do have a bit of headroom for improvements, then you can get yourself out of that hole.
Absolutely. And with new builds are quite often simply overpriced. Okay, the attraction of a new build is that it is new and you are going to be the first home buyer. Okay, you will be the first person living in the property. Because of that, they are priced quite highly. Reality is, once you are living in that property, it is no longer a new property. And therefore, it is sort of vulnerable to whatever the market conditions are. Okay, so for that reason, new builds, yeah. It's quite common that when you buy a new build, in the couple of years after buying it, sometimes the value may not have moved, or it could even have gone down. A lot of the time, people will have struggles selling new build properties in the couple of years after the purchase. Reason being, a lot of home buyers, if they're buying a property in that area, would just like to buy an actual new build, and not your second-hand property on the estate.
Okay, so we understand interest rates. We're ready to get this mortgage. We're going to go for 20% deposit, and we're going to go for a 2-year fixed rate. Look at me, I'm learning, okay? But we're self-employed, or we don't have a very long history of employment. What are the potential problems there?
Yeah, so there's a little bit of a mortgage myth that self-employed applicants have access to different mortgage products in comparison to employed applicants. That isn't the case.
What do you mean by different products?
So, as in, nationwide, we'll have a set of interest rates for employed applicants and a set of interest rates for self-employed applicants. That isn't the case. Okay. The mortgage deals or products, which is interest rates paired with fee arrangements, okay, are the same for employed applicants as it is self-employed applicants. The difference is the evidence is how you evidence your income as a self-employed applicant. Okay. So if let's say you are employed on a permanent contract, most mortgage lenders are going to ask for 3 months pay slips. Okay. That means you just need to evidence your income over the latest 3 months.
Okay.
If you are self-employed, most lenders are going to ask for 2 years of history.
Wow.
Okay, so that may be your latest 2 years company accounts if you are a limited company director, or your latest 2 years tax calculations or tax year overviews. Okay, reason being, rightly or wrongly, I don't make the rules. Lenders view self-employed income as being perhaps a little bit more volatile, a little bit less reliable, and for that reason, they want more evidence to show that your business is successful and you can rely on it to fund your mortgage.
What would your advice be to someone that's in the position of being self-employed, and maybe they've got a really good accountant that makes them look more unsuccessful than they actually are? Where do they go from there? Do they have to make the trade-off of paying more tax for a few years just to prove that they're earning any money? Is there something else they can do?
So you're right. So a lot of the time, business owners, and when working with an accountant, will default to being tax efficient. Okay. What that can mean sometimes is there's a lot of expenses. Sometimes your income may not show as exactly what you feel it is. And if that is the case, that can restrict your mortgage borrowing, because mortgage lenders want to see your income figures from your tax calculations and your company accounts. So if you are a business owner working with an accountant, it's important that you let them know that your main financial goal may be to buy a home, and and not so much to be tax efficient. Okay. And that may mean declaring, as much income as possible, that's down to your accountant. That's not something I would advise on, what figures your accountant can submit. It all needs to be correct, and that's a conversation to have with them. Yeah. The more income available within your documents, the more mortgage lending you can access. So yeah, have a conversation with your accountant and let them know what your financial goals are. and that it maybe isn't just being as tax efficient as possible.
So essentially what you're saying is that there is a trade-off to be had with not saving on tax and being able to prove that you've got a certain amount of income.
Depending on the figures, yes, there can be. There can be. So yeah, it's just about having an awareness. And as well as that, if you are a business owner who's planning to buy a home in, let's say, 2 years' time, you should be having a conversation with a mortgage advisor and let them know what your goals are. So let's say you want to buy a £500,000 property. I would then let you know what your income figures need to look like over the next 2 years for that to be achievable. You can then take that and go to your accountant, and they can then advise you on whether or not that's possible, and if it is possible, what you need to do within your business to achieve that. So yeah, both parties, your mortgage advisor and your accountant, can work together to help you to achieve the goal.
Okay, so we understand all of this. We're ready to pull the trigger on a mortgage. We need to find a home. What comes next?
Yes. So let's say you have a deposit and you are ready to buy. Okay. At that time, you will be having a conversation with a mortgage advisor. Let's imagine the working with myself. We would have a mortgage appointment in which we discuss your circumstances, your goals, how it is I can help, what that journey is going to look like moving forward. We will then get your documentation in. So that may be proof of income. So payslips if you are employed, company accounts or tax calculations if you're self-employed, bank statements, credit report, ID, proof of address. When I've got that, I'll build your file, complete a thorough review of that file, complete research of the market, speak to lenders where necessary, run calculations, and I look to get something called an agreement in principle. An agreement in principle is a document from mortgage lenders stating that we would consider lending to Elliot a certain amount of money, and that includes a credit check. Now, if I give you that to my home buyers, that will be accurate because this is what I do. Therefore, you will know exactly what's achievable. Okay, so you'll know whether when you are viewing properties or whether you're lying in bed scrolling on Rightmove, right? Dan's told us we can access this loan amount. We have this agreement in principle. Therefore, you can get out there on the house hunt with full confidence and full clarity. Okay.
And before we go any further, what's the difference between a credit score and having a credit rating?
There is no difference in those two. Credit scoring, there's many misconceptions around this. Okay, so your credit score. There's no one-size-fits-all perfect credit score because whether you are using ClearScore, Experian, Equifax, TransUnion, they will all have their own scoring systems. Okay, so yeah, what is a good credit score? It's very difficult to say. Okay, but when we are applying for a mortgage, they will run a credit check on you. So the mortgage lender will run a credit check that will include a credit score. However, all mortgage lenders have their own internal scoring systems. Okay, that's individual to the lender. The main difference is credit score versus credit report. Okay. So your credit score is essentially like your school grade at the end of the year. Okay, and your credit report is more like your school report, which documents how you've been behaving financially over the latest 6 years. Okay. Mortgage lenders are actually more interested in the credit report. Okay. Each lender has their own credit criteria. So scoring is less important. It's more so lenders will state, we allow 2 missed payments in the latest 3 years. We allow 1 default in the latest 6 years, but it can't be in the last 2 years. Okay. And every lender's breakdown is completely different to one another. Okay. So when the lender runs a credit check, they will essentially scan your credit report and see if your information matches their criteria. If it does, fantastic, we will pass. If it doesn't, that could be a fail. But if you do fail with one mortgage lender, that's not necessarily the end of the world. Every lender's criteria is different. As a mortgage advisor, we don't run credit checks blind. We do so on an informed basis. So before I ever submit a request with a lender, I will always have reviewed your credit report, and let's say you have a couple of missed payments in the last 2 years, I'll be able to state, right, this lender won't accept you, but this lender will, and we will look to proceed with that lender.
All right, we've got all of that covered. What are some of the extra costs apart from just putting down a deposit and paying interest?
Yeah, so you will need a solicitor to carry out all of the legal work associated with buying a home. How much that costs is impacted by the property that you're buying. You know, things such as it being a leasehold property can have an impact. The value of the property, whether you are being gifted any deposit funds, all of these things can impact the cost. Okay, as well as
Can
that,
we just stop there? And I know this
Yeah.
might be oversimplifying things so much, but I want to make sure that this episode can be used by anyone who's in school and they're pissed off that they're learning about bloody chlorophyll rather than what's
Yeah.
actually important in their future. What does a solicitor actually do?
So your conveyancing solicitor, which is a solicitor who works within property, so they will send off a property searches to the local councils, which means they're essentially assessing the local area to make sure that there's nothing that's going to impact your property, okay? Such as the property being built on top of a mine or there being sort of gas issues in the area. They
Some
will
unexploded
organise...
World War II bomb.
Exactly, stuff like that. Well, I'm not sure they cover that, but yeah. As well as that, they will organise the transfer of funds between parties. So the mortgage lender, the seller, yourself, they will complete, or they will help you to complete the relevant paperwork to make sure that you are exactly where you need to be legally, and essentially support you through that process. When buying a home, the legal part of the process typically can be the worst part of the process. Why? It's the part that people least understand. How long does it take? How long's a piece of string in most cases? Your solicitor will not be able to tell you when you are going to complete until they have agreed a date. Okay? Then that could be a week before completion. So you may be moving forward feeling like you're doing so sort of blind as you move through those months. And yes, a lot of solicitors in the UK are taking on too much work. They're quite overly busy.
Interesting.
Quite often there are communication issues, or people feel like there are communication issues. So yeah, when buying a home, that part of the process, you do have to manage your expectations because it can be a little bit frustrating.
It's fascinating hearing from my family in Sweden. And they talk about how buying a house can literally be done in the space of like 2 weeks and you've got the keys. Very different in the UK.
Very different. So yeah, we see a lot of that online. The fact that buying a home in the UK, it is mental. You know, you're buying a property and it can run on for up to 6 months and you still don't know if you've actually got the property on a lot of occasions. That purchase can sometimes collapse. You might have, paid thousands of pounds for surveys, solicitors, other fees. And yeah, it's certainly, it's quite a outdated system, some may suggest.
What do you mean by that?
It's just, in terms of the length of time that it takes and the fact that when you move through the process, you are never entirely sure that the process is ever going to complete. And as you've mentioned, in countries such as Sweden, they have a completely different system. Now, I'm not well versed in that. However, naturally we do think surely there must be a better way of doing it somehow. What that looks like, I don't know. However, buying a home in the UK is or can be incredibly stressful.
Well, sticking on the theme of other countries in comparison to the UK, I saw that Denmark have been offering 20-year fixed rate mortgages at 0%. What are the trade-offs to that? And is that something that would be possible in the UK ever? Or is there something else going on underneath that makes it all actually not as good as it sounds?
So in terms of the Denmark product, I wouldn't be able to state. However, in the UK, there are some lenders, there's quite a few lenders who offer 10-year fixed products. Okay. And there are some lenders available who offer even longer fixes. Okay. In the UK, there isn't really an appetite for it. If there was, the products would be available. Now, let's talk about a 10-year fix. So these are 10-year fixes are the longest fixed term periods that are available with mainstream lenders. Okay. The issue with a 10-year fix is that you are fixed for 10 years and tied in for 10 years. If you leave that deal early, you will then pay early repayment charges. Now, reality is that it's hard to predict your life over the next 10 years. Whether that be wanting to move home, wanting to jack it all in and go traveling, or a separation, a divorce perhaps. that is the reason people tend to avoid longer fixed term periods, especially for my younger first time buyers. A 10-year fix just isn't suitable because you simply don't know what's going to be happening throughout your 20s or throughout your 20s and what life is going to look like. I actually did a post on Instagram recently, and it was the number one reason why a 5-year fixed term deal becomes unsuitable for my home buyers, okay, after they've taken it. And it isn't that they feel it isn't the interest rate. It's not changes in the market or anything like that. It's relationship breakups.
Wow.
Quite commonly, I will have, I'll first-time buyers, a young couple will buy a property. Everything's fantastic as far as I would know. And then a year later, Dan, we've separated. We're in a 5-year fix. There's early repayment charges. What do we do? That's extremely common. So that's just an example of one of the downsides to a longer fixed deal.
But I wonder what the trajectory is on that, given that more and more marriages are ending in divorce. I think it's 40% now. And this bifurcation is happening in Gen Z, where there's a divide between men and women in terms of their political leanings and their interests. What does that transfer over to in terms of the future of mortgages and sharing the cost?
Yeah, it's difficult. So in terms of how that impacts mortgages, so in terms of, you mentioned the average age of a first-time buyer these days, the contributing factors to that, in my opinion, are, one, it's difficult to buy a home. But on top of that, culturally, the world's opening up. More people want to travel, more people want to relocate. As well as that, people are the typical stage in life when you might buy a home, which might be a long-term partner, starting a family. Less and less people are doing that. Or if they are doing that, they're doing that at a later stage. And I think, as well as the fact it's so difficult to buy a home in the UK financially, I think these are also areas that are contributing to that.
So what would be some of the consequences of buying these homes for the first time at a later age compared to doing it when you're 24?
There aren't necessarily any negative consequences. It is more so a case of if you are 25 now and you're thinking, I might wait until I'm 40 to buy my first home, we simply don't know where property prices will be then. We're already looking at incredibly high property prices in comparison to average earnings. In some places in London, that's as high as 14 times. So if you plan to wait another 15 years, we simply don't know where property prices will be. And that may or may not make it hard for you to then make the purchase if that's a goal of yours. Other than that, though, a consideration we have with my older applicants is your mortgage term. So most mortgage lenders will allow you to borrow for a residential mortgage to around about 70 or 75, depending on the lender. Okay. Now, if you are 25-year-old, you have the option of going with a 40-year mortgage term. Whether or not that's advisable is down to the individual. However, the longer the mortgage term you have access to, the lower the monthly payments. Okay, because you're paying the mortgage back over a longer period. You would then pay interest back for a longer period. Okay, so there's pros and cons. However, if you are 50, okay, some lenders will only allow you to take a 20-year mortgage term. Therefore, meaning if you want to buy a property, the monthly mortgage payments might be higher for you for that reason than it would have been if you had bought sooner.
Fuck, that's so interesting. It's all of these things from the podcast are coming together. You've got this liberation of women, especially going to university, absolutely crushing it, working careers, amazing, really good news. And they're putting off having kids. Men are not being as successful in university. It's taking them longer to settle down and earn enough money to be at a point where they can even consider having a mortgage. All of this coincides with other cultural factors at play. So people aren't having kids until much later on. And actually, we're about to face a population collapse with the depopulation bomb going off because our total fertility rates are so low. But on top of that now, how this ties into it is that you've got people buying homes later, so they're going to have to pay more monthly for the home, which makes it even harder to buy a home. And if they can't do that, they're renting, they're going from place to place. They're not going to be able to settle down and raise a kid, let alone two, let alone three, to actually replenish the population. So it seems like everything sort of compounds and collectively makes it harder for any of this to be solved.
Yes, and we spoke about the lifetime ISA earlier, and I mentioned one of the considerations with the lifetime ISA. Another consideration with the lifetime ISA is that the property purchase price cap is £450,000 to use a lifetime ISA. Now, reality is the average age of a first-time buyer is increasing to around about 34, which may be seen as a typical age for starting a family, perhaps. Okay, and if you're starting a family and you're wanting to buy a home, you're going to need a bigger property. And if
just
you are
on that, before you continue, because this is super important, all the studies show that once a woman reaches 30, if she hasn't had kids, she has a 50% chance of ever going on to have kids. So that's some important context to lay in before we continue with 34 being the age that people are trying to buy a house and settle down.
Yeah, absolutely. And it's a huge consideration because people are buying the first home later and often needing larger properties. And in certain areas of London, you can't buy a suitable family home for less than £450,000, therefore rendering the lifetime ISA useless to some people. The issue with that is, though, the lifetime ISA encourages us to continue to save into it over quite a long period of our life to work towards buying a home. But sometimes you will get to the point of being ready to buy and it will no longer be suitable for one of the reasons mentioned. And then if you choose to withdraw that money because you can't buy a suitable property with it, there are penalty fees to do so. So yeah, it's quite a challenging one if you are, especially more so in areas such as London and certain areas down south. It's less of an issue where I am in the northeast, where property prices are a little bit cheaper. But yeah, it's all there's a lot to consider.
Yeah, and I can imagine, given social media and all of this noise online of wanting to live this metropolitan lifestyle and go to the pub after your finance bro career and have a few drinks by the business district, people aren't just going to take the trade-off of moving up north to actually be able to afford a house. People rather just hold off, and then maybe it's too late. The biological clock has ticked, for example, for having kids, if we're sticking with the kids theme, and it's too late. And then you get into issues of finding a partner that you can stay with, finding the same interests when you're a bit older. It seems like a very tricky situation.
It is. It absolutely is. There's so many moving parts at play with buying your first home, especially in the UK at the moment. You know, when you mentioned about moving out of certain areas in order to buy a home, you know, London is one of the only places where if you are from London and living in London, if you want to buy a home, you have to leave home because in certain areas it simply isn't achievable for a lot of people. So yeah, I think relocating is something that, you know, a lot of my home buyers do need to consider, especially those based in London, whether it's moving to a cheaper area, moving slightly outside of London, having to maybe make a commute in order to buy a home. It's a huge consideration.
This is a horrible question to ask, but I want to have asked it. How many, if you know, of people that are young that are buying homes in their early 20s? I know that it used to be like a third of people 20 to 24, 40 years ago. And now, God knows what that is, but definitely not 1 in 3 of my friends are homeowners, to say the least. That's the understatement of the year. How many of these people are just buying it with mummy and daddy's money?
Gifted deposits are extremely common. I think it's around about 37% of home purchases.
Wow.
I think it's around about 30% of first-time buyer purchases are using a gifted deposit in some form.
Wow.
Okay, so I think saving a deposit is incredibly hard, and I think more people are having to rely on that. To add a little bit of context to that, so I'm a dad with 2 kids, and I genuinely believe when my children are 3 and 10 months, okay, and I genuinely think if I can't fund their house deposit in 25 years' time, I don't think they'll be able to buy a home because I don't think the market's going to improve in the next 25 years. I think it's incredibly unlikely that in 25 years the market's going to be in a better place. So I really think that if they want to have the opportunity of buying their first home in 25 years' time, I feel like I'm going to have to be able to gift them some deposit funds.
That's ridiculous. It's a system where you've got people that are homeowners or they're landlords, and they've essentially got the incentive of the market just increasing in ridiculousness for prices because they profit off that. And then you've got working class people who are essentially waiting for their aging parents to die, and they're waiting until they're in their 50s or 60s until they potentially inherit their property or split it with their sister or brother or whatever. Is there anything you can do to flip that within 30 years? Or is this a long-term 50-year project that's going to have to be undertaken?
I don't think there's... So people will say, how do you fix the property market? Okay, and then the question will be, well, what is fixing the property market? I imagine it would be affordable properties with affordable mortgages. Okay, that may be fixing the property market. I don't see how that can be achievable. Reality is, in the next 10 years, house prices aren't going to half to allow people to buy a home by themselves within the UK. That's just not going to happen. So I think it is more of a case of managing the increase in property value over the next 5, 10, 15, 20 years. I know I keep coming back to London, but London prices in London are so expensive. They're so high. It's crazy. What you can buy in the northeast for £450,000, for example, okay, would be an amazing 5-bedroom family home. Beautiful, in a lovely area, detached, amazing property. In certain areas of London, that's going to get you a 1-bed flat. And it's I don't see how that's going to improve in the coming years. So I think if you are buying a home in London in the next 15 years or so, you might be catching the last train.
Can you imagine a future where people just have enough and move countries because that's the only way of getting a house?
I think relocation will become more common. Whether it's moving countries, I'm not so sure for the common man or woman. But yeah, I think relocation is going to become more common.
So to backtrack back to what we were talking about before, let's finish off this. Let's tie a ribbon on the potential hidden costs and extra fees that there could be with a mortgage.
Yes. So solicitor fees. As well as that, if you are working with a mortgage advisor, some mortgage advisors charge fees. Fees range for a residential purchase, most of the time, anywhere between £0 and £1,000. Okay. As well as that, depending on the price of your property, you may have to pay stamp duty for the purchase. Okay. If you're unsure about whether or not you're going to have to pay stamp duty, there's a fantastic website, stampdutycalculator.org. It's got an easy to use calculator. You can input figures to match your circumstances, whether you're a first time buyer, you're a home mover, or whether you're buying an additional property. You can input the figures in that information and it will let you know what the stamp duty is going to be. As well as that, some mortgage products do have fees attached. Okay. Typically, mortgage lenders will charge a fee for you to access a lower interest rate. Fees are avoidable on mortgages for most applicants, but it's just something to be aware of, and to chat to your advisor about.
Something I'm fascinated by is the geopolitics of all of this, because we've got a lot of people from outside the UK, from Russia or from the United Arab Emirates, buying up properties in London, in Mayfair. At least that's what I hear from a lot of people down the pub saying, you can't walk through Mayfair without seeing Russian-owned shops everywhere. It's a challenge to try and spot the British shop. How much truth is there in that essentially the nicest apartments in London are standing empty as investments from other countries?
Yes, whether it's from other countries, I wouldn't be best placed to say. However, yes, landlords in the UK do own a large portion of the properties. And that is making it, again, difficult for people to buy properties for themselves. There's simply less properties available. Now, somebody may say, right, well, Dan, there's these flats in London that are sitting empty. Why aren't people buying those? Or there's these people struggling to sell, quite often because they are overpriced and undesirable and maybe not a good investment for the buyer. Okay, and that's the reason they're empty in the first place. But yeah, there's so many properties in the UK which are owned by landlords, of which, it's a fantastic opportunity to be a landlord. I've got nothing against landlords, but yeah, it's one part of an ever sort of complicated puzzle.
Do you think they're really sitting empty because they're bad investments, though? I mean, these people are clearly profiting a lot of money from just sitting tight and then eventually selling.
So some properties, so not necessarily owned by landlords, but some properties are sitting empty in terms of maybe people are struggling to sell them because they may be flats, as mentioned. They may be sort of newer flats, which have the potential to go down in value, and therefore they are maybe not desirable purchases for first-time buyers. So in terms of the properties with the landlords, I wouldn't really be best placed to say because, in London, I'm not based in London. And I would have maybe wouldn't comment too strongly on that.
I wonder if there's some way of, and this is with my bloody bro science unlocked economics hat on, even worse than my usual bro science philosophy hat. Is there any way of purging the housing market so that actually those people that can't sell the flats because they're overpriced suddenly can, and the people that can't afford the overpriced flats suddenly can?
I really don't think there's a quick fix. I really do think it's a very complex puzzle, and you see so much talk on the news about fixing the housing market or online, and whether it's building new properties, but it's important that if we are building new properties, they are desirable properties that sort of the working man can afford, and they are suitable for the average buyer. But yeah, it's in terms of a quick fix, to be honest, I can't see it. I think it's more about managing where we are and maybe hoping that it doesn't get worse or even more challenging.
But I wonder how much of this with the new builds is actually a reflection of our culture and our society as a whole, this sort of limbic capitalism where we're interested in what looks good and what's shiny and what's flashy. And we're at a point where almost our expectations are so high for what's presentable to other people that we sacrifice what's fundamentally essential for a fulfilled life. So you've got all of these new builds that people can't afford, but they don't want to build anything that's older and more functional because it's not as marketable. So we've kind of trapped ourselves in this paradox.
Yeah, with new build properties, especially in the area, I can speak about the area in which I'm from. They are priced so significantly higher than a non-new build property. In terms of the space, if you switch from a new build to a non-new build, the space that you can get in the older property is really significant. For the same price, you can get an extra bedroom. And a lot more space downstairs. It's, new build properties, people like the idea of the fact it's new and it's only ever been your property, and it's sort of it's standing start, so you can make it your own and nobody else has really sort of left their mark on it. But yeah, in terms of the price versus the space that you get, whether or not it's worth it will be down to the individual. For me personally, my first home was a new build. When I moved home last year, now I've got 2 kids, got a family. We simply couldn't. Yeah, the new build wasn't an option due to the increase in cost and the sort of decrease in space in the house.
Yeah, I rented an apartment when I had just turned 18 in London for a year, and that was a new build studio. I was taking off plastic from everything because I was the first person to live in it, and it was absurdly priced for what was actually a pretty cheap build, even though it was new. And I don't know if I would go down that route again. And this was just renting, because it just seems like the trade-offs are not in the favor of these new builds. And I guess it depends what point of your life you're at. As an 18-year-old, I was very excited to be moving into somewhere where I was the first person to live there. But I think maybe it's just part of growing up that I would make a slightly different choice now.
Perhaps, well, as my first home was a new build, I was just as excited when I bought that property. But with new builds, they have their own issues, whether it is the quality of the build, the gardens of a new build. On TikTok, new build gardens get a lot of flack, sort of being sort of soulless, some people may say. But yeah, new builds are a fantastic option for the right buyer, if it's the right property. But yeah, in terms of cost, it is something that we have to weigh up.
So in lieu of trying to desperately find solutions to this very black pill conversation about the housing market, could we potentially see in the future a Japanese model 100-year mortgage where our kids actually inherit our debt?
I can't see that happening anytime soon, to be honest. I think the market will stay just about where it is for over the next few years. And yeah, in terms of the model itself, there are people come to the market with sort of longer fixed term periods, as we spoke about earlier, but the appetite just doesn't seem to be there. So yeah, in terms of the model, I do think it will be sticking as it is for the foreseeable future.
What would you want people to have as their biggest takeaway about mortgages? What's the biggest flawed perception that you'd maybe want to shift about mortgages?
Yeah, so you'll see a lot of information on it's always on TikTok. You'll see certain personalities on TikTok stating, do not buy a home under any circumstances. You've got to be wary of the information on social media and how balanced it is. It's important that when you are consuming content, making sure that it is balanced, and understanding what the agenda may be for it. Buying a home in the UK isn't going to be for everybody. I'm not here to sell somebody that buying a home is the perfect scenario. It isn't. There are high upfront costs. Okay. However, buying a home is not purely an investment. So when people compare it against, investing in the S&P 500, it's a completely different thing. Buying a home isn't just an investment. It's a safe space for your family. It's a garden for your kids to grow up in. It's a place to make your own. So there isn't a direct comparison there. So yeah, but yeah, I would just say when looking to buy a home, preparation is key. It is a difficult market. So start planning early, have an awareness of your credit early, speak to an expert early, and you're going to need a deposit. So as much as you can, try and start saving towards a deposit. Reality is that buying a home won't always be a priority. When you're navigating your 20s, it might be traveling, it might be just having fun, it might be career and relocating and moving about. But we do need to have one eye on it if it's going to be a goal in the future. So as mentioned, not making a mess of your credit when possible. And yeah, sort of having a conversation with an advisor so you can lay some foundations. And when it comes to buying a home, it's not all going to be a big shock to you.
Well, one of the best quotes of all time, Thomas Sowell, there are no solutions, only trade-offs. And I think that's very much the case with buying a house. It depends what point of your life you're at, what your priorities are, and what costs you're willing to take to pursue those priorities. So I can totally see some of the trade-offs and some of the flaws with getting a mortgage, but also I can see long-term maybe the value and the sacrifice that you have to take if you do want to settle down and have kids one day.
Absolutely. And there's 4 questions you should ask before buying a home. Can you afford the upfront costs? So deposit, fees, stamp duty. Can you afford the ongoing costs? So mortgage, insurances, utilities, maintenance. will it add value to your life? So do you value the security? If you do, fantastic. If you don't, no problem. And finally, I forgot the last one. Oh yeah, what are the alternatives? Okay, so maybe you're in your mid-20s. What are the alternatives? Maybe you have the option of staying at home with your parents for a few more years and continuing to save that deposit to allow you to buy either a better property or access a better deal in the future. Or another alternative may be renting. So what does the renting option look like for you? Can you get a nice property on an affordable budget when renting? Or maybe, you can't quite rent the sort of properties that you'd be happy with. Therefore, buying would be a better option. So yeah, those are the 4 considerations you need to be making.
Dan Does Mortgages, thank you so much for coming on the show. Where can people find more of your work?
Yes, so my main page is my Instagram page, which is at DanDoesMortgages _. On there, you will find daily sort of tips, tricks, educational content to help you with a home purchase. As well as that, there are testimonies and client success stories from my home buyers who are successfully buying homes in the UK.